So you know what? Let's ask our market guest also what he thinks about this. Jyotivardhan Jaipuria, founder and MD at Valentis Advisors, joins us now to discuss the market. Mr. Jaipuria, good morning and thanks for joining us. You know, I am going to ask you about the market call, but I don't know if you heard Rima just going through that note over there. And I want to ask you particularly on financials because I know you do like the banks. So take us through what is your call on them. Are you still very optimistic on that space? It has been a favorite across the board.
Yeah, so we do like the banks, and we are I've been pushing it quite a lot on the earlier shows also. So I just managed to hear a bit of what Rima said. So in some sense, you know, what they say is right, that deposits are going to go up. And that is something which we've said also, that in the initial phase of the interest rate increase, the margins expand for the banks, but later on it starts to catch up. But what we also believe is as deposits rise, because the credit growth is strong, you're going to be able to pass that on. So you'll be able to maintain margins because even the lending rates will rise in an environment where credit growth is strong. The other thing we have to remember is, a lot of the cleanup has happened. So you'll have NPLs which will keep coming down over the next couple of years. Third is we still believe that there will be a corporate capex. So a corporate capex cycle in India will happen over the next 18 months, and that will be good for the credit growth. And that's where, the banks will still be good. I don't know if they are making a very tactical call because, banks have been one of the best performing sectors in the last 3-4 months. And so to that extent, maybe the banks take a bit of breather. But over the next 1 year, I would still be positive on the banks.
So you differ from Edelweiss in the sense that you believe the system is capable of absorbing higher lending rates, and you don't anticipate corporate capex cycle being pushed forward too much. It should pick up in the next 1.5, 2 years. What about IT? They've upgraded IT to neutral, and the reason is it's great cash flow generating business. It's underperformed. The margin outlook is improving. Would you concur?
So, Rima, our call it's been a very simple call that we are saying buy local and avoid all the global plays. And the reason for that is the global economy is going to go through a lot of pain. We don't know how bad the pain will be. My view is there will be a recession in US. There will be a very deep recession in Europe. So to that extent, the whole demand environment, how questionable it will be, how much the growth forecast will get cut is going to get questioned. So in that environment, I don't want to keep playing something. And these stocks are good quality stocks, but they're not exactly cheap. They've done badly for some time. So there could be some tactical play in it. From what I could understand, even they are not overweight IT. They're just, upgrading it from very negative to neutral or something. But we've been avoiding IT. We are quite a bit negative on IT.
Okay, negative on IT. What you are positive on is the cement space, which at least for Q2, the results that have been coming through are looking quite disappointing. I mean, we have Ultratech today, so let's see how that goes. But Shree Cements, India Cements were quite bad. Is there any kind of change in call, or do you think that this cycle will continue to play well?
No, so, we like cement now because we know that the results are going to be bad. So, last 1 year, EBITDA was under pressure, EBITDA per ton, because, what we were seeing was an increase in the input cost pressure. Now that input cost pressure is easing. So, going forward, one is you'll have lower input costs coming. Second is there'll be more pricing power now that the monsoon has got over. So we've seen price increases come through for cement companies in the month of October. So I think, we are probably at the bottom of the EBITDA per ton for the cement industry. The September quarter will be the bottom of the cycle. From here over the next 3-4 quarters, we'll see EBITDA per ton going up for cement, plus we'll see some demand expansion, so volumes also will be up. So, it's a sector which, you should buy on all the bad results now, not get perturbed about the bad results.
Okay, buy the bad news in cement this quarter. In banks, just to go back to that point, would you start looking at PSU banks, or would you only buy the private sector banks? If credit cycle is going to pick up, especially on the corporate front, it's the PSU banks who generally benefit, and that's where there is that valuation comfort. So would you buy PSU banks?
So, Rima, from my point of view, whether it's a PSU or private, it doesn't matter. The way I classify it is there are retail banks and there are, corporate banks. So we've been positive and we continue to be positive on the corporate banks because that's where the cycle is going to help you. That's where all the NPL pressures will start easing. So within corporate banks, we don't mind looking at a PSU or the private sector. At the moment, of course, we don't have a PSU because a lot of cheaper private sector banks, which probably have same valuations and they give you the same characteristics as a lot of these public sector companies.
All right, got that. Mr. Jaipuria, we're going to leave it on that note. You like the banks, you like even cement, but you're going to avoid the IT space. And you're overall telling us buy local and avoid the global play. So thank you very much for joining us and taking us through.